Welcome back to Alpha Recap. I'm Cassidy. Today we're breaking down a broad market pullback that hit tech especially hard after the close. And as always, if you have questions, you can reach us at stockalpha.ai.
Thanks, Cassidy. Good to be here. The trading day closed with clear divergence. Some big winners earlier in the rally took a step back, and that showed up very visibly in the indices.
Let's start with the headlines. The S&P 500 closed down about 0.5%. The tech-heavy Nasdaq finished down about 1.75%. And small caps ended the day down just under 1%. That paints a picture of profit-taking, right?
Exactly. When the Nasdaq underperforms the S&P by that much, it usually signals rotation out of richly valued growth names. This was a classic earnings and positioning move layered on top of renewed crypto weakness.
Walk me through the three main drivers that we flagged today.
First, earnings-driven volatility. Several high-profile reports, think major semiconductor and software suppliers and big healthcare and mobility names, created headline risk. Second, cryptocurrency weakness. Bitcoin pressure and related headlines hit crypto-exposed equities and fintechs. Third, profit-taking and position adjustment after recent tech outperformance. Traders tightened stops and shifted to more defensive spots late in the session.
Earnings often move markets, but why did modest guidance or cautious commentary have an outsized impact today?
Because of concentration. A small group of mega-cap tech names carry a lot of the market's weight. When traders see uncertainty around margins, demand, or capital spending in those companies, it ripples through the whole growth complex and exaggerates index moves.
Crypto headlines also came up a lot. How did developments in crypto affect equities?
Crypto moves accelerated risk-off flows. When Bitcoin and other tokens softened, exchange operators, miners, and some fintech names took hits. Also, news around token trading and derivatives, like exchanges' product plans, can quickly change the risk profile for public companies tied to that ecosystem.
Sector by sector, who led the downside and who held up?
Communication services and information technology were among the weakest. Media policy headlines and semiconductor sensitivity weighed heavily. Financials were mixed, with certain fee-driven businesses holding up better. Energy and materials were relatively resilient on geopolitical and supply chain chatter. Utilities and real estate attracted defensive flows and helped cushion the S&P. Consumer discretionary was mixed, with some retail names showing early signs of momentum, and healthcare was all over the place thanks to innovation and policy headlines.
Any individual stocks worth calling out from the day?
Yes, a few stood out. A large consumer electronics and entertainment name declined after guidance flagged a one-time charge. Semi- and server-related names were volatile after earnings. A major biotech and a big ride-hailing company also drove headlines, and crypto-related exchanges and miners were clearly under pressure from the token and derivatives news.
We also saw a bunch of 8K filings moving niche names. How should traders treat those?
8K filings often create idiosyncratic moves. They matter for the specific stock, but they don't usually change the broader market story unless they point to systemic issues. Traders should respect the headlines, read the filings for the catalyst, and avoid treating every filing as a market-wide signal.
Let's talk Fed implications. Did anything in today's action change the rate outlook?
Nothing radical shifted. The market continued to balance signs of slowing inflation with still solid labor conditions. The key takeaway was that rate expectations remain fragile. If inflation or employment surprises to the upside, investors will likely push out hopes for rate cuts, which hits long-duration growth stocks harder.
So traders are watching upcoming CPI, PCE, and employment data closely?
Absolutely. Fed messaging and the incoming data calendar will dominate flows. Earnings commentary that touches margins, pricing power, or labor costs is getting extra attention because it informs how companies would perform in a still restrictive policy environment.
On the technical side, you mentioned leadership breadth narrowed. Explain that in plain terms.
Sure, breadth measures how many stocks are participating in a rally or decline. When the Nasdaq fell much more than the S&P, it meant only a handful of mega-cap tech names were doing the heavy lifting to push indexes higher before, and then did more to push them down. That concentration can hide weakness in the broader market until it matters.
Small caps underperformed today. Is that a warning sign?
Small caps tend to be more sensitive to domestic growth and credit conditions. Their underperformance, down about 0.9%, suggests some investors trimmed risk broadly. So if small caps continue to lag, it could reinforce a shift towards safer, larger cap or defensive holdings.
Volatility was elevated. How did traders position into the close?
Tactical traders move toward defensiveness late in the session. Utilities select energy and dividend-focused financials. Momentum players tighten stops on tech and crypto-exposed names. Longer-term investors use the intraday swings to reassess balance sheets and guidance instead of chasing short-term moves.
Looking ahead, what are the concrete things we should be watching in the next session?
First, continue watching earnings and forward guidance in tech and healthcare. Second, any further crypto or derivatives headlines could keep related equities volatile. Third, Fed commentary and key inflation and jobs data will remain market moving. Fourth, on the charts, see if the S&P held recent short-term support and whether the Nasdaq can reclaim its intraday losses. Finally, watch small cap behavior for signs of shifting risk appetite.
Quick practical tips for listeners, traders, and longer-term investors after today's action?
For traders, manage exposure, tighten risk controls around momentum names, and be ready for headlines to move crypto-sensitive stocks quickly. For longer-term investors, use volatility to reassess fundamentals, balance sheets, cash flow, and guidance, rather than reacting to every headline.
Let's wrap with 3 clear takeaways from today.
1. Concentrated leadership can flip quickly when earnings and headline risk collide. 2. Crypto headlines remain a volatility multiplier for certain equities. 3. Fed-driven data and messaging will continue to set the tone for growth versus defensive performance.
Great. That's a concise summary. Thanks for walking us through it.
Thanks, Cassidy. It was a reminder that markets can move fast when several risk factors collide, so staying disciplined matters.
All right, that's it for today's Alpha Recap. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. See you next time.